Hey, what's up guys? Recently we've seen Musk's diet pills go viral, and the stocks of companies like Eli Lilly and Novo Nordisk are soaring to new heights. But hey, not everyone's popping the champagne. This could put some pressure on snack brands that have been leaning towards the junk food side of marketing. According to Markets Insider, as people are getting more into healthy eating, it's predicted that companies selling junk food might be the potential losers in the weight loss pill craze. Apparently, these GLP-1 drugs reduce people's cravings for sugary and fatty foods. So, imagine our beloved McDonald's and Burger King, they might be in a bit of a pickle, right? But guess what? The reality is, McDonald's just released their financial report for the third quarter of the 2023 fiscal year. And their sales have actually increased by a whopping 14% compared to last year, reaching a staggering $6.692 billion, beating analysts' expectations of $6.577 billion. What a surprise, huh? And let's talk about McDonald's stock performance. Sure, the news about the diet pills had some impact on their stock price for a couple of days, but guess what? They quickly bounced back and showcased their resilience. As the global fast food leader, McDonald's stock has been outperforming the market by a mile, and it even hit an all-time high recently. If you look at McDonald's stock performance since it went public, even in 2008, 2012, and 2020, their stock has been pretty solid and, to some extent, outperformed the market. So, folks, here's the deal. How does this fast food giant manage to keep thriving and even reach new heights? Plus, there have been some major changes for McDonald's this year that have a big impact on our daily lives. Like, are burger prices going up or down? And this is crucial for all you McDonald's investors out there. Well, I'm Sheila Wang, bringing you the latest and freshest business and investment info. Don't forget to smash that like button and subscribe to my channel. And hey, I want to hear from you in the comments section. If you're interested in a more detailed investing report, check out my analysis report below. Now, let's dive into today's topic together. First things first, from a business perspective, let me break it down for you. How does McDonald's manage to rake in those high revenues when the economy is uncertain and we're facing a downturn? Well, despite the tough environment, consumer demand in the US has actually remained surprisingly strong, exceeding expectations. Yeah, we're dealing with some hefty inflation, but guess what? McDonald's, being the fast food giant it is, has shifted the burden of price increases onto us, the consumers. You've probably noticed it too. This year, McDonald's menus across the globe have seen varying degrees of price hikes. In July, for the first time in 14 years, they bumped up the price of their cheeseburgers in the UK. In September, some of their popular items in Australia saw nearly double the price. And guess what? At the end of September, McDonald's in Japan announced they'd be raising prices by around 60% due to rising costs and currency fluctuations. And back in the USA, McDonald's already raised prices by 8% in their Q1 report, and they even scrapped some of their promotions. In the first 3 quarters of this year, McDonald's sales reached a staggering $7.042 billion, a 4.5% increase compared to the same period in 2021. And you know what's driving that growth? Yep, you got it. Those menu price hikes. So, in simple terms, by shifting the burden of cost increases onto us, McDonald's has not only achieved steady performance but also gained recognition from the capital market. What's more, the McDonald's has this killer business model that's all about low-risk assets. It's like their secret sauce for staying on top. And get this, a lot of people don't even realize that nowadays. The big bucks for McDonald's are coming from real estate rentals and brand licensing. Yeah, flipping burgers and fries is just a side hustle for them. McDonald's has this mind-blowing 4-tier profit model. And let me tell you, the 4th tier is where the magic happens. First, we've got the operational revenue, where they make money by selling their products and pocketing the difference. Now, for the average Joe, this seems like the most important source of income, right? But it actually only makes up 1% of McDonald's overall revenue. And get this, they give most of that profit to their franchisees to attract more of them and expand their brand's influence. So, in a nutshell, they're not making much from selling burgers and stuff. Next up, we've got the supply chain revenue. This bad boy contributes 20% to McDonald's total revenue. See, since McDonald's gave away most of the product profits to their franchisees, they attracted a ton of them from all over the world. And with over 40,000 stores globally, McDonald's has some serious bargaining power in the supply chain. Let me give you an example. If you want to be a chicken supplier for McDonald's, you gotta use their specified feed and chicks. Heck, they even dictate the chicken coops and lighting. So, guess what? McDonald's can charge higher prices for feed and chicks and make a killing. Others sell feed for $300. McDonald's can charge for $100. Someone else sells chicks for $5. McDonald's can charge $8. And if suppliers refuse to play by their rules, they can say goodbye to collaboration. Moving on to the third tier, we've got systemic revenue, which accounts for 30% of McDonald's overall revenue. The headquarters takes care of everything from choosing locations, decorating and equipping restaurants to managing operations and hiring employees. They've got a whole system in place, and they pass on their proven strategies and management systems to their franchisees. And get this, once a store starts making profits, the headquarters sells it to the franchisee. One store sold for $8 million. Imagine if they have 10,000 stores, that's $800 billion. Whoa! And now, the fourth tier, financial revenue. Here's where things get really interesting. You see, before McDonald's came into the picture, some areas were like ghost towns. Nobody wanted to be there. But guess what? When McDonald's sets up shop, those areas become hotspots. Land prices and rents skyrocket. So, what does McDonald's do? They set up a real estate fund and snatch up those properties at rock-bottom prices or lease them for 30 years at a steal. And when those ghost towns turn into prime locations, they rent them out to their franchisees and make bank on the price difference. In the end, commercial real estate contributes a whopping 50% of McDonald's profits. They're like the kings of renting. So, my friends, McDonald's success is all about their strategic genius. They established their overall strategy of making bank from real estate 60 years ago. And on top of that, they keep refining their tactics, providing top-notch standardized management and service experiences. And guess what? They duplicate that success worldwide, making McDonald's an unstoppable force in the fast food game. Mind-blowing, right? So now, we're about to spill the beans on their global domination plans, especially in China. You won't believe what's been going on. Alright, so picture this. After 6 long years, McDonald's bought back its own brand, and guess what? Its valuation skyrocketed 5 times. That's right, they're making serious dough in the Chinese market. How did they do it, you ask? Well, a big shout out goes to CITIC China International Trust and Investment Corporation and Carlyle, who became shareholders in 2017 and brought the whole localization game to the table. They understood the Chinese youth like nobody else and rocked the digital marketing scene. But hold on, my friends, because the game is changing. With the rise of local Chinese dining options, international giants like McDonald's and Starbucks face new challenges. So, for McDonald's, going all in on the Chinese market wasn't just a multiple-choice question. It was a full-on challenge. And guess what? On November 20th this year, McDonald's announced they're acquiring 28% of McDonald's China shares held by Carlyle. The deal is expected to close in the first quarter of 2024. According to the official statement, after this transaction, CITIC Consortium will continue to hold a controlling stake of 52% in the company, while McDonald's global stake will increase from 20% to 48%. Now that's what I call a power move. You see, These ownership changes in McDonald's often reveal their future moves. And after expanding like crazy in the past 6 years, their next move is to level up in the Chinese market. It's all part of their master plan to deepen their strategic layout. And that's not all, my friends. On December 6th, McDonald's China and Huawei made a big announcement. McDonald's China app is going to be powered by Harmonious Next for native app development. With over 5,500 restaurants, more than 200,000 employees, and serving over 1 billion customers every year, McDonald's China is one of the first global restaurant chains to jump on the Harmonious native app development bandwagon, from where you can see their ambition and strategic deployment. Fourthly, why we can still keep confidence on Mc is because McDonald's is a capital safe haven and it is a solid investment. One of the reasons McDonald's has become a capital safe haven is its long-standing track record of high returns in the stock market. And you know what that means? It's all about those fat dividends. Over the years, McDonald's has been dishing out some serious cash to its shareholders, with a cash dividend payout ratio consistently exceeding 50%. Just take a look at the numbers. In the past 3 years alone, they paid out a whopping $3.582 billion, $3.753 billion, and $3.919 billion in cash dividends, while raking in net profits of $6.025 billion, $4.731 billion, and $7.545 billion during the same period. Even in the rough year of 2020, when profits took a hit due to the pandemic, McDonald's cash dividend payout ratio soared to a staggering 79.33%. And guess what? In the first 3 quarters of this year, they've already dished out a cash dividend of $4.14 per share, with a total payout of $3.057 billion. But wait, there's more. McDonald's isn't just about those fat dividend checks. They also know how to boost their stock value through share buybacks. For regular shareholders like you and me, a company buying back its own stock is like putting cold hard cash in our pockets. It reduces the number of shares in the market, increases earnings per share, and creates a scarcity that drives up the stock price. Cha-ching! In the current market climate, high returns, especially through buybacks, are what the big boys in the capital world love. And let me tell you, McDonald's is the king of buybacks in the stock market. But here's the catch. While they've been showering shareholders with dividends and buybacks, their total debt far exceeds their total assets, and their net assets have been in the red for a long time. Plus, to keep up with those high dividends and buybacks, McDonald's has been selling off its own assets left and right. It's a delicate balancing act, my friends. Now, let's take a moment to show some respect to this century-old establishment. McDonald's has always been at the forefront of change, riding the waves of history. Through action, they've shown us the true meaning of being a gentleman in the business world, innovation, and keeping up with the times. That's the key to staying relevant, my friends. Cheers to McDonald's and its timeless journey.